In 2008, the Bucksbaum family was worth $2.2 billion. Their empire controlled hundreds of American malls, and everything looked unstoppable. Then the credit markets froze. General Growth collapsed into bankruptcy. Its stock fell to 50 cents, and billions in family wealth disappeared. The family's fortune plunged to roughly $300 million. But 5 years later, it had climbed back to approximately $1.8 billion. Part 1. The Empire. The man who built America's shopping mall empire. In 1954, a young Matthew Bucksbaum opened his first shopping center in Cedar Rapids, Iowa, beginning a business empire that would transform American retail. The idea was simple but powerful. Build convenient shopping centers where families could find groceries, stores, services, and everyday necessities close to home. Matthew and his brothers understood that successful retail real estate was not simply about buildings. It was about attracting people and reliable tenants. The brothers expanded their portfolio, and General Growth Properties gradually became a serious player in America's rapidly growing suburban retail economy. By 1970, General Growth had gone public, giving the family access to capital that could accelerate its expansion across America. 15 years later, the family sold its earlier real estate trust for roughly twice what it had originally invested, proving their model worked. General Growth continued buying malls and properties, expanding far beyond its original Midwestern base into a national commercial real estate powerhouse. In 1984, General Growth completed a landmark transaction, selling 19 malls to Equitable Real Estate for approximately $800 million. By the 1990s, General Growth had become a major American mall operator, while Matthew moved the company's headquarters from Iowa to Chicago. Matthew's son, John, entered leadership, eventually becoming chief executive in 1999, as the family prepared to hand its empire to another generation. By 2007, General Growth had grown into America's second-largest REIT, controlling roughly 194 malls and planned communities across 44 states. At the height of the real estate boom, the Bucksbaum family's fortune reached billions, and their mall empire appeared almost unstoppable. Part 2. The Big Bet. The billion-dollar bet that changed everything. By the early 2000s, General Growth was already enormous, but the Bucksbaums wanted something bigger. More malls, more properties, and national dominance. Then came an enormous opportunity, the Rouse Company, another major American shopping mall owner with a valuable portfolio of properties across the country. In 2004, General Growth agreed to acquire Rouse for approximately $12 billion, creating one of America's largest shopping mall empires. The acquisition dramatically increased General Growth's financial obligations, requiring billions in new financing to complete the transaction and expand the combined empire. The banks backed the expansion, and General Growth secured a massive credit facility to finance the Rouse acquisition and manage its growing portfolio. The strategy worked initially. Rouse expanded General Growth's reach, while the combined portfolio gave the company greater scale and stronger bargaining power. By 2006, General Growth amended its acquisition financing with a $5 billion senior credit facility, keeping the enormous property machine moving. For years, the strategy appeared brilliant: rising property values, strong mall revenues, abundant credit, and investors willing to reward aggressive expansion. But Matthew had already stepped down as chairman in 2007, leaving the next generation to navigate the company's increasingly ambitious strategy. His son John had led General Growth since 1999 and now faced responsibility for an empire operating at unprecedented scale. At the peak, General Growth controlled enormous assets, but its debt obligations were becoming increasingly dependent on the continued availability of cheap credit. Then the credit markets began tightening. What had looked like unlimited financing suddenly became a dangerous question. What happens when the banks stop lending? Part 3. The collapse. When a $30 billion empire collapsed. In 2008, America's credit markets began freezing, and the cheap financing that had fueled General Growth's expansion suddenly became much harder to obtain. General Growth had enormous loans coming due, but lenders were becoming increasingly unwilling to refinance billions of dollars of commercial real estate debt. In 2008, approximately $4.2 billion of General Growth's debt came due, while only about $3.7 billion could be successfully refinanced. As investors lost confidence, General Growth's stock price collapsed, destroying market value even though its malls remained valuable physical assets. By the depths of the crisis, General Growth shares fell to only 50 cents, a stunning collapse for America's second-largest real estate owner. By early 2009, General Growth was buried under roughly $27 billion of debt, with some reports describing its mortgage burden at nearly $30 billion. Matthew had already stepped away from leadership, but he watched as the company he built across decades approached its greatest crisis. John Bucksbaum had already left the CEO position in 2008, as the financial crisis increasingly threatened the company's survival. The company needed billions in refinancing, but lenders demanded stronger protection and refused to keep extending the loans indefinitely. With refinancing options disappearing, General Growth faced an impossible choice: surrender valuable assets immediately or seek legal protection from its creditors. On April 16, 2009, General Growth Properties filed for Chapter 11 bankruptcy protection, marking the largest real estate bankruptcy in American history. On April 16, 2009, General Growth Properties filed for Chapter 11 bankruptcy protection, marking the largest real estate bankruptcy in American history. Part 4. The Fight Back. The billion-dollar rescue that saved the empire. After bankruptcy, General Growth still owned valuable shopping malls, but its financial structure was broken and required an extraordinary rescue. The strange reality was that the company still controlled hundreds of valuable properties. The problem was no longer the malls, but the debt. A group of powerful investors saw an opportunity. Brookfield, Fairholme, and Pershing Square were prepared to provide billions of new capital. The proposed restructuring included billions of dollars in new equity, giving General Growth the capital needed to rebuild its financial foundation. The final restructuring plan included approximately $6.3 billion of new equity investment in new GGP from major institutional investors. General Growth also negotiated restructuring agreements covering approximately $15 billion of project-level mortgage debt, extending maturities and reducing immediate pressure. The restructuring would divide the old company into two publicly traded businesses, separating the mall operations from other real estate assets. The new GGP would focus on retail real estate, emerging from bankruptcy with more than 180 shopping malls across 43 states. For the Bucksbaum family, the rescue meant accepting a painful reality. The empire they built would never return in exactly the same form. On November 9, 2010, General Growth officially emerged from Chapter 11, ending 19 months of one of America's most complex bankruptcies. The empire had not disappeared. It had been rebuilt under a new financial structure, with valuable properties still generating income for the company. For a family whose fortune had nearly vanished, the company's survival created something priceless: another opportunity to rebuild their wealth. Part 5. The Comeback. From $300 million back to $1.8 billion. Even after bankruptcy, the Bucksbaum family still owned millions of General Growth shares, giving them a valuable connection to the company's future. After 19 months of bankruptcy, the reorganized General Growth returned to public markets with a completely rebuilt financial structure. The shopping malls had never disappeared. They continued generating rental income, attracting customers, and providing the underlying assets needed for recovery. As confidence returned to real estate markets, General Growth stock recovered dramatically, restoring significant value to the family's remaining ownership. The family had fallen from an estimated $2.2 billion fortune to roughly $300 million after the bankruptcy, an extraordinary loss. Yet $300 million was not zero, and the surviving family assets gave the Bucksbaums a foundation from which to recover. Then something remarkable happened. Only 5 years after the bankruptcy, the family's combined fortune had climbed back to approximately $1.8 billion. Their fortune had recovered sixfold from the bottom, proving that bankruptcy had destroyed enormous wealth without permanently destroying the family's financial future. But the comeback came with a price. The Bucksbaums no longer controlled General Growth, and their family's original empire had permanently changed. Matthew Bucksbaum died in 2013, leaving behind a business legacy that had survived one of the most devastating collapses in American real estate. The numbers tell the extraordinary story: $2.2 billion, then $300 million, followed by a recovery to approximately $1.8 billion. The Bucksbaum story proves that losing a fortune and losing everything are not always the same thing. Sometimes survival creates another path forward. This chapter ends here. Thank you for watching The Global Money Story. Join us in the next episode for another extraordinary story of wealth, failure, and comeback.